Banks are like that fake friend who compliments your outfit, then badmouths you to someone else. They smile at you from behind the counter, hand you a free checking account, and then quietly charge you $35 for buying a coffee 2 hours before payday. Yeah, this isn't service, it's strategy, and you're the revenue stream. Today, we are exposing top money traps banks don't want you to know about, from shady overdraft tricks to how your loyalty funds their bonuses. More importantly, we'll show you how to make their strategies work in your favor. If you don't understand how the system really works, you're not banking. You're just bleeding money. By the end of this video, you'll know how to spot the traps, protect your cash, and stop donating to your bank's billion-dollar empire. Because the only interest they have in you is compounded monthly. Let's start with one of the biggest silent killers of your bank account: overdraft fees. Now, on the surface, overdraft fees might seem like a small slip-up penalty. You spent more than you had in your account, fair enough, right? But what most people don't know is that these fees are not just little punishments. They are part of a deliberate system designed to maximize profit at your expense. Here's one of the biggest tricks banks use: transaction reordering. Let's say you made 3 small purchases, $5, $8, and $12, and then later paid a $100 bill. Common sense says the smaller ones go through first, right? Wrong. Banks often process the largest transaction first. Why? Because they like to clear larger payments first, which results in your account dipping into the negative. Those smaller charges now become separate overdrafts. That's 3 fees instead of 1. Multiply that by thousands of customers and you've got a billion-dollar business model. So remember, when banks reorder your transactions, it's not a glitch, it's a feature. Because nothing says customer service like turning 1 overdraft fee into 3. In fact, U.S. banks rake in over $11 billion a year from overdraft fees alone. That's not helping customers manage their money. That's legalized wallet robbery. It's like when your dad used to send you to the store with a $20 bill and you pocketed the $9.18 for your troubles. What's worse? Some banks will still charge you an overdraft fee even if your account dips below zero by just a few cents. Imagine paying $35 because you were short on a $4 coffee. Yeah, they don't mention that in the commercial with the smiling banker handing you a free pen. And don't get too excited about overdraft protection either. Sounds like a safety net, right? It's not. All it means is your bank will allow the transaction to go through and then hit you with the fee anyway, sometimes more than once in a single day. That's like your boyfriend charging a grocery fee to move the meat from the freezer to the fridge to thaw. If your bank is doing this, it's time to start shopping around. There are digital banks and credit unions out there that have eliminated overdraft fees altogether, because while mistakes happen, turning them into profit shouldn't be the business model. Knowing this, the next time your account dips a little too low, you'll know exactly who's benefiting. And it's not you. Ah, yes, the good old free checking account. Sounds like a dream, right? No monthly fees, no strings attached, just you and your money vibing in peace. Except there are strings, a whole web of them actually. And if you don't read the fine print, that free account starts costing you more than you'd ever expect. Let's break it down. Most so-called free checking accounts come with a list of conditions, and missing even one of them turns your free ride into a fee party. We're talking minimum daily balances, required direct deposits, mandatory debit card usage, or transaction count requirements. Don't hit that minimum $500 direct deposit? Boom! $12 maintenance fee. Forget to use your debit card 10 times in a month? Kapow! Another fee. It's like playing a rigged game of hide and seek with your own money. Who knew hiding in your favorite spot would result in being the seeker? Kind of silly, huh? And the kicker? Banks bank on this. Literally. They know most people won't read the full account disclosure. They know life gets busy, people forget rules, and eventually you'll trip up, and that's when they cash in. Even worse, some accounts start off free but become fee-ridden after a trial period. Kind of like a toxic relationship that starts with flowers and ends with you covering the tab. You can do better. So no, these accounts aren't always what they seem. But here's the good news. You have options. There are online banks and credit unions that offer actually free checking accounts. No minimums, no surprise fees, no games. These institutions often run leaner and rely on transparency and tech to deliver a better experience. The bottom line? If your free checking account is acting more like that clingy girl from the gym that you agreed to go to lunch with, it's time to switch banks. Because every dollar you give away to unnecessary fees is a dollar that's not building your future. Here's a sad reality they never mentioned in school. Your traditional savings account might be slowly draining your wealth. You heard that right. While most people think putting money in a savings account is a smart move, and hey, it used to be. The truth is, today's interest rates are often so low, they don't even keep up with inflation. That means your money is technically losing value every single year, even though the number on your bank app stays the same. The power of $100 today does not have the same purchasing power next year. Remember those 25-cent bag of chips as a kid? Yeah, they're 50 cents now. Let's say your bank offers you a generous 0.5% interest rate on your savings. Sounds okay until you realize inflation is hovering around 3 to 4% per year. So while your bank is tossing you a few cents a month like you're a kid on allowance, the actual purchasing power of your money is shrinking. And it gets worse. Banks aren't just sitting on your money. They're taking your cash and flipping it into loans, mortgages, and investments, all earning them way more than what they're giving you. They use your deposits to generate huge returns and then toss you a few peanuts for allowing them to house your funds. It's like giving someone your car for a week and them handing you back a bus ticket and a smile. This is where people get stuck. They think having a savings account means they're being financially responsible. But if your money is sitting in an account that pays less than inflation, it's actually going backward. It's not savings. It's slow motion loss. So what should you do instead? Start by looking into high-yield savings accounts. These are often offered by online banks with fewer overhead costs and better interest rates, sometimes 10 times more than traditional banks. They are currently averaging 4 to 5% annually. It won't make you rich overnight, but it will at least keep your money working for you, not against you. Want to level up even more? Look at investment accounts like index funds that allow your money to grow over time. Just make sure you have a solid emergency fund first, because investments carry risk, and you don't want to pull money out when the market dips. Bottom line, don't let your savings account be a comfy graveyard for your cash. Put your money somewhere it can breathe, grow, and outpace inflation. Because safe shouldn't mean slowly going broke. Credit cards, the shiny plastic rectangles that promise freedom and cash back but often deliver stress and a debt hangover. Let's be real. Credit cards aren't evil, but the way they're designed. Oh, they're absolutely engineered to keep you paying and paying and paying. Here's the game. You get a bill. Let's say it's $1,200. But your statement says, "Hey buddy, don't stress, just pay $35. Sounds helpful, right? Wrong. That's the minimum payment trap. The bank is basically saying, we'll let you off the hook, for now, but we'll be charging you 20% interest for the next decade. Just think, they give you 0.5 to 1% on your money, but charge you 20%. Who's really winning? And don't let the word minimum fool you. What it really means is maximum profit for them, minimum progress for you. If you stick to minimum payments, that $1,200 could cost you double or more by the time you're done. Who knew you would be paying on that Papa John's until you're 40? The system is built to reward slow payers, not because it helps you, but because it helps them. Banks make billions in interest from people who never default, never pay late, but just take their sweet time paying off their balance. You're not a customer. You're a long-term investment. Now, if you're thinking, well, I'll just pay off the whole thing every month, then congrats. You're doing what 90% of people don't. But if you've got debt already piling up, you need a strategy. Start by paying more than the minimum. Even $50 or $100 extra can save you months of payments and hundreds in interest. Or look into balance transfer cards with 0% interest promos. Just be sure you pay them off before the clock runs out. Credit cards can be tools or traps. The difference is whether you're in control or just another line on their monthly earnings report. You walk into your local bank branch thinking you're about to get financial guidance. You sit down with a representative. They smile, offer you a mint, and ask how they can help. But make no mistake, you're not at a help desk. You're on a sales floor. Most bank employees aren't trained financial advisors. They're sales reps with performance targets. That friendly conversation about your future, it's likely scripted to funnel you into a product. A new credit card, a higher interest loan, or a savings account that comes with more strings than a puppet show. Banks track metrics like products per customer, and branch staff are often incentivized with commissions or bonuses based on how many accounts, cards, or loans they can get you to sign up for. Your life goals? Great, but they'll probably be tied to whatever quota they're trying to hit that month. And hey, can you blame them? They're doing their job. But the problem is when you think you're getting advice, and what you're actually getting is a pitch. Imagine going to a doctor who gets a bonus every time they prescribe a certain brand of medicine. Yeah, suddenly that checkup feels a little sketchy. If you're serious about making smart money moves, don't rely solely on someone whose income depends on your decision to sign up for a premium checking account. If you need real financial guidance, talk to a fiduciary financial advisor, someone legally obligated to act in your best interest. Or educate yourself with books, podcasts, or even videos like this one. Your money deserves advice that's based on your goals, not someone else's commission. So next time you walk into a branch, remember, you're not just a customer, you're a lead. Walk in informed, or better yet, don't walk in at all. Trying to close a bank account should be easy, right? You'd think it's like canceling Netflix. Click a button, maybe answer a survey, and you're out. But with banks? Oh no. They treat closing an account like learning Mandarin. Suddenly, it's complicated. You might need to call 3 different departments. Some banks require written letters. Others insist you show up in person with multiple forms of ID, even if you opened the account online. It's 2025, and yet they make it feel like you're closing out a medieval scroll instead of a checking account. Why? Simple. Retention is revenue. Banks know that every extra day you keep your money parked with them is one more day they can use it to earn. So they use friction, confusing policies, long phone waits, vague instructions, to make the process just annoying enough that you think, forget it, I'll deal with it later. Some will even throw in a guilt trip. Are you sure? You'll lose your rewards points. Or they'll magically offer you a bonus to stay. Sound familiar? Yeah, this isn't banking. It's a breakup with customer service playing the ex who suddenly changes after you're done. Look, if a company makes it hard to leave, that's a red flag. Before opening any new account, take 5 minutes to read their account closure policy. Know what the exit door looks like before you walk in. And if you're already with a bank that's giving you the runaround, be persistent and document everything. Your money, your rules. Don't let a bank act like it owns your time, your choices, or your patience. Because if they have to trap you to keep your business, they probably never deserved it in the first place. Drop a comment below. Which bank move shocked you the most? Or which one have you been hit with? Let's swap stories. help each other dodge the traps. And if you found this video helpful, hit that subscribe button. We break down money, mindset, and the system in ways school never did. You're not powerless. You're just now getting started. Now I hope that makes sense.